private lenders, when you are underwriting a potential new loan, you're going to want to be comfortable with the borrower's exit strategy. And a lot of this comes from experience. And if you don't have all that much experience in underwriting exit strategies up front, we're going to shortcut all of that for you right now.
Welcome to the Private Lenders Podcast with your hosts from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
I mean, it is true that a lot of this stuff just comes with experience. We've seen so many deals over the years, having funded over 4,000, and it's just too common that borrowers come, and especially when we're talking about refis. We're going to talk about some other potential problematic exits, but so many borrowers come like, yeah, I'm going to use your loan to acquire the property, maybe acquire and rehab it, and then I'm just going to refinance to pay you off. And then we'll take a quick look at, maybe their financials, credit, income of the property, and we're like, from experience, this is pretty unlikely.
Yeah. So this topic kind of came up from a borrower that came into the office today. And we're going to tell a little bit about his story here in a second. But one of the things I mentioned to him, and I was like, listen, I hate to say it, but we're all contingent on banks and some sort of bank financing, even if we don't use banks in our business. I mean, we've done 4,000 loans with all private capital, right? We don't have any institutional backing, but we're still contingent with banks, right? We wanted the flexibility to do it with private capital so we don't have to deal with banks, but we're still contingent on banks because guess what happens? The exit strategy, when one of your real estate investors fix and flips a house and they sell it, who are they selling it to? They're selling it to a homeowner that is getting a bank loan. Or on the other side, they're like, oh, hey, I'm going to refinance this into a DSCR bank loan. Great. Well, now you're contingent on banks lending and interest rates based off that. It's something that's just so overlooked that any way we look at it. Okay, so forget that rant. Let's go back to kind of the importance of the exit strategies in general. If you go to the 4 C's, right, collateral being number 1 and then character being number 2, the third one's capacity, which has to do with do they have a valid exit strategy in place? Because it's so important. And I hate to say it, but you almost have to be the overlord or the babysitter, knowing what's going to happen on this deal before the real estate investor knows what's going to happen on this deal. You need to be the professional to make sure they're able to accomplish what they think they can accomplish. Chris started this off of hey, someone's got bad credit and, oh yeah, I'm just going to buy the property and, I'm going to just do credit repair and I'm going to refinance it and I'm going to get a bank loan. It's no, you're not. Is that possible? Maybe. Is it likely? Most likely not. That's very rare that happens. So let's just use an extreme example of something just so you kind of get the point. So somebody buys a property for $400,000 and they have a lot of cash in it. And you do a loan of $100,000. You do a really low LTV loan, but they don't want to sell the property and they have bad credit. They don't really have any other options. Maybe they can get another hard money lender to potentially come in. Maybe they have a business that they can pay it off in cash, but you're in a great position and most lenders won't ever say no to that deal. The problem is you need to be aware of what their exit strategy is. And if it's doable, if not, you're just going to have a loan that's on your books forever. And hopefully it cash flows with rental income that they can cover the debt service. Hopefully they have other means to make the monthly payment. And again, I'm not saying don't do this deal. My point is the exit strategy thing, we're doing short-term loans. The exit strategy is such an intricate part of it that you have to make sure that it's viable when writing that. If not, it's just going to be stuck on your books.
Yeah, and when we look at those deals, happens every day. When we're okay, the collateral's great. We're at the right LTV where we want to be. They're bringing cash. They're invested in this thing, and a couple things can happen. One, if we think it's unlikely they'll be able to refinance to pay us off, but that is their plan, they've stated to us, we'll oftentimes use an addendum to the term sheet saying, okay, at the end of the loan term, if you are unable to refi, then I agree to sell this property. Does that mean they'll actually do it? No. But does it help? Yes. And also psychologically, it puts in their head that, shoot, if I can't get a refi, then I have to sell. Because nobody wants foreclosures. We're trying to avoid defaults, limit them as much as we can. And Sometimes that works. There's other weird situations where, for some reason, borrowers are just like morbidly clinging to this property, refuse to sell it. They're just racking up default interest and attorney's fees, and they still refuse to sell it. And they might even declare bankruptcy to extend the torture even longer. It's weird, but it happens oftentimes. That's one tool that we use, is have them state up front that, okay, if I can't get the refi, I'm willing to sell.
Yeah. So there's kind of like two sides of the exit strategy conversation. And Chris and I had this conversation on, I mean, literally we have this every day, but there's a deal that we're pursuing, that we have a term sheet out that's going out today, in this situation where a borrower inherited a portfolio of properties. One of them was a nice single family property that has a tenant in there, or had a tenant in there, I should say. They need about a 30-ish% LTV in order to re-renovate the property, because the tenant had some issues. They want to get it, and they don't want to sell the property, but they have bad credit. They're like mid-fives credit, and they're like, oh yeah, well, I'm working with a credit repair company. I have bad credit because this happened. Collateral were good. The problem is, are they going to be able to figure out a way to exit the loan? And they have multiple properties as well, which is good. They're going to be able to support the debt until the tenant moves in. But really the factor that is the most important is this person going to be able to make an intelligent enough decision where they can figure out and navigate an exit strategy? And that's really what it comes down to on some of these deals. Because there's there's a difference in, you can have the exact same credit score. Two different people can have the same credit score on paper, but be very different avatars, right? They can have very different characteristics. So then it's our job as an underwriter, as originating this loan, as being responsible for this loan, is this person going to make the right decision that I trust will exit this deal one way or the other? And if they can't get an exit strategy, if they can't get a refinance in a year, are they going to sell the property? Or do they have means? Do they have high global cash flow from other rentals that they could pay it off? What's going to happen in that? And what's going to happen when the term is over? Because that's really the thing. And there's no easy answer to that. You have to, and that's why I think when you start out, you really need to be meeting all your borrowers, at the very least, going to all their properties, then maybe working your way into potentially doing a Zoom call or something else, just so you understand what that is. Because this has gone both ways. Sometimes we've dealt with borrowers that are just completely unsophisticated, will always make the wrong decision, and then you're just stuck forever. And then on other sides, they're like, oh yeah, well, this is my backup plan, or my backup plan, or my backup plan, or my backup plan. And they know what's up. So you really got to know who you're working with in those regards, because that's the difference between having a clean portfolio and an absolutely miserable portfolio.
I'm glad you brought up inherited properties too, because those have more risk. One, because the person who owns this property, they might not be in the business of acquiring real estate. They might not be a professional real estate investor. They only became a real estate investor because their parents, typically, they were that. They were owner-operators of real estate and knew what to do, how to handle situations. And that doesn't mean that the heir will. And so you gave that one example of the one that we're doing a term sheet on today. We'll see how that one plays out. Maybe check back on a future podcast. But there's another one that we own currently. It's a 5-unit property in DC. It's rare that we get to foreclosure sale. It's more rare that we end up owning a property, but it has happened a couple times this year. And in this particular case, it was one of those situations where going into it, we did a pretty low LTV bridge loan, $300K on a property worth somewhere between 500, 600, maybe a little more. Tenant occupied, 5-unit, small apartment building, right? And it was looking at it borderline of whether or not they were going to be able to get a refinance, maybe mid 600 credit, cash flow is good enough. Not so sure about their exact profile in terms of personal financials. But anyway, looking at it going into it, it was borderline whether or not they were going to get permanent debt refi. Turns out, after a lengthy process and attempting to refi probably 4 or 5 different times with different lenders, they weren't getting this refi. And we were telling this borrower, look, you got to sell. If you can't refi, you have to sell. It's just the way it is. You don't want us to foreclose. That's not helping anybody, not helping you, not helping us, not helping the tenants. And they refused to do that. It was their parents' property. they had in their mind that I'm never selling this. And we had to foreclose on it. We had to go to auction sale. It wasn't purchased at auction. So now we took it back and we're in the process of preparing it to sell. And it was just a shame because they could have, and there was multiple bankruptcies extending the situation. And it was really a shame because she could have sold that property long before, a year or maybe even 2 before we got to an auction sale, and made some good money and gotten out of it. Instead, it just went through a few, bankruptcy cases and then an actual foreclosure, like not a good exit. So like, moral of the story being, and I think we're going to get into some property type stuff.
Yep, that's next.
Moral of the story being, like, regardless of the property type, that it's important to have honest conversations with the borrowers up front, because you might want to do the deal because it is a low LTV and it's what they want, it's what you want, right? But having an honest conversation up front about how this could play out at the end, I think is a responsible way to go about this type of lending.
All right, so that was talking about the borrower. Now let's talk about the assets in general, because I think that's important as well. So single family houses that are nicely that will be nicely renovated in certain areas that there's demand, usually can sell pretty quickly. Let's be honest with that. Suburbia, in the city, obviously, when you're pulling comps on the front end, what type of inventory is on there? Like, is there more actives or is there more solds? I mean, it really depends on what real estate market and cycle that we're in. But like, hey, listen, if we're in a cycle where you pull up and there's 20 properties between active, under contract, and sold, and there's like 4 sold and there's 16 that are like active, that's an issue, right? Like, you really need to lower your after repair value, knowing that the exit strategy could, number one, be a lot lower than expected, and number two, take a lot longer than expected. So that's one side of it. But mostly single family residential stuff is pretty clean and easy. The challenging part is the commercial properties and the mixed use. So let's have a conversation about that real quick. So on our books, our commercial portfolio on our books, our commercial loans, our commercial assets on our books is probably the cleanest portfolio, the cleanest ones. Everybody makes payments on time. The quality of borrowers are very strong. The LTVs are very, very low. There's a higher level of sophistication. There's a higher level of barrier to entry for commercial buildings than there are for, smaller single family stuff, right? Just the amount of cash outlay that somebody needs. So that's good. The issue is the exit strategies. The exit strategies, they just take longer. It is hard to get a commercial loan exit in a year, and our terms are a year. And then we do extension fees and we do things like that. Maybe we do some workouts, we do partial principal pay downs, but they all perform. We're happy with that. The issue is they take longer. So you need to underwrite for that. You need to take that into consideration. You need to make sure you have the right capital stack. If you're raising private capital for a commercial deal and a capital investor is expecting their money back in 6 months or else, that's a challenge, right? So all that stuff has to be taken in consideration, and know that a commercial property refinance, because most of them are refinances, they use us as a bridge to get into the deal, and then they want sort of a cheaper term exit. I mean, we've shared this story before, and at this point, this loan's paid off. I think it paid off about 6 months ago. But we did a loan on like an 18-unit professional office, and the purchase price was, call it like 1.6, and we lent them $800,000, maybe even lower than that. They had 1031 money, they had other cash, whatever the case was, and high 700 credit, decent leases for professional office. Professional office, you're not getting 20-year leases, right? You're getting between 1 and 5 year leases, technically, maybe as high as 7. And the bank wouldn't do it. Like, it took them 3 years to get a freaking refinance. It was awful, but it covered our debt service. That's an important part, right, of the commercial loan. It covered our debt service. She just wanted to go from a 12.99% interest rate to an 8% interest rate. That was the goal. Like, that's a big savings. The point is the exit strategy just takes significantly longer. And back to the story that I was going to say when we started, we had a borrower in our office that we have 3 mixed-use properties, loans on 3 mixed-use buildings that he has. He's like, dude, I can't get my buyers to finance these I can't get my in essence, they're leased out to his tenants. They're rented out, and these are like mixed use, right? So it's like a 1-bedroom apartment up front and a small storefront in downstairs, either like, a delivery food service or a flooring store, things like that. So smaller stuff. And the what we've done with him in the past is he'll put up half, we'll put up half. So like he'll buy a property for 200 grand, we'll give him 100 or 110-ish. He'll put up 100-ish, give or take. And he knows he never wanted high leverage on these. And I don't recommend doing high leverage on deals like this, but he didn't want high leverage on them because now he's in a situation where like he can't get these freaking things off his books, and he's trying, and he's qualified, and he's trying to get his tenants to buy these things, and they want to buy them. And not that they'll never get done, but they're harder to get done. The exit strategies are very, 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 very challenging. And they're not like single family houses. Like think about the neighborhood that you live in. Think about what the value of your property is. Now, let's say you needed to sell this property desperately, like next week, next month, a few months from now. Like think about what price that would be that a buyer would come in and scoop that up immediately. 10% less, maybe? Like not that much less. That doesn't work on commercial stuff, right? I'm not saying you can't come up with a fire sale value, but the variance is way different than on the residential side. Just things to take in consideration when you're underwriting. That's why our max LTV on a commercial loan is 50. Typically, we try to stay closer to 40.
Yeah, I mean, sometimes people are amused, especially lenders in the mastermind group. They're like, how do you get all these 40 and 50 LTVs? It's like, well, we have to put out a lot of quotes to get those. But I mean, that ends up
on commercial deals, that's kind of industry average. Like people aren't getting high leverage on commercial deals, and they shouldn't. And they shouldn't want it. Dude, literally 1 hour before we were recording this podcast today, I said, hey, the best part about your situation, because like he's at the point where he's got so much freaking, he's got trapped equity in all these deals. And he's like, listen, I'm sorry these things took longer. That's not the situation. Like, he's like, I literally got, a few $1 million tied into a bunch of these deals. And it's locked. And like, it sucks. Like I'm trying to get this stuff out. And I'm like, hey, listen, the good news is you were smart up front, and we were both smart together where you brought real cash to this table. So like, if we did higher LTVs, you wouldn't, you'd be in a way worse situation. And then you couldn't even afford the debt service on it. And then this liability, this asset would have turned into a liability like that because the debt service would have just eaten up all your equity. So that's the reason we do these things, right? It's not like, hey, like I just want to lowball people. We do them because we've seen them through the process of what happens if you don't.
Yeah, I mean, that is one of the good things about cash flowing properties, even if they like the commercial stuff and certain residential rental properties, is that even if they can't get out of it, they oftentimes keep performing because they have cash flow coming in. We'll do extensions for them. We can figure it out later. If they're making the payment, then we're all good. But still, the important part to take away from this conversation is, have those talks with your borrower up front. I don't know about your exit strategy. I don't know if a refinance is going to work. Are you willing to sell? Like, just be open and honest. Hopefully everyone's on the same page. Hopefully the situation works out well for both the borrower and the lender. It's everybody's goal. We appreciate you checking out the pod today, guys. And also, if you haven't done so already, check out Lender Software, lendrsoftware.com. Quickly becoming the most popular loan management software in the private lending business. The founder, Bryce, is a member of the Mastermind, really good guy. Check it out, lendrsoftware.com, and we'll see you here next time on the podcast.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.